How investment fees destroy safe withdrawal rates when it comes to your retirement plan. It's always fun to come across an article that speaks the truth that gravity exists. This is as obvious as saying gravity exists. However, there's still lots of pushback. I had a guy on my YouTube channel the other day say, Josh, I get what you're saying about investment fees, but if I'm paying 50% and I'm getting 100%, that's better than paying 1/10 of 1% and only getting 5%. And I said, okay, that's true. If you're paying 50% and getting 100%, that is better than paying 1/10 of 1% and only getting 5%. It's a silly argument to make, though. Here's the reason why is because are you going to get that return? I just look at David Swensen, I think it's Swensen, or I can't remember. Swensen from Yale Investment Endowment back in the late aughts. Everyone's like, we got to follow the Yale Investment Endowment model. Just that there's so many passing fancies here, man. And it's just you don't know what is going to do better in the future. A 3 to 5 year track record is a big fat nothing burger. Chris Davis from Davis New York Venture used to say, and he probably still does, haven't followed him for a while, and I like him. He's a good investment manager. But he says, look, the stellar investment managers are going to have 3 to 5 years where they underperform significantly. The question is, can you hang in there? And the reason is because they're going to take concentrated risk. That's all. The only way to outperform is with concentrated risk. And then it's just luck. Hopefully their concentrated risk pays off. It's just a matter of luck. That's why Burnt Malkiel from Princeton did the random walk down Wall Street. The facts are some risks pay off, some risks don't. But at the end of the day, it's all luck. It's all random. We don't know. So let me show you how the markets work again, because I think this is important to understand. In the markets, you have various constituents. You got some over here. We got some over here, some over there, some there, some there, some there, some there. All these people are investment managers vying to outperform the average. They're all vying to outperform the average, right? And so what we have is we say, okay, what is the average? Well, the average is simple. It's literally we add all these guys up, we divide by the number of constituents, and that gives us our average rate of return. So this guy got 10, this guy down here got 6, this guy over here got 25, this guy up here got negative 30. That's what we do. And you take them all and you divide and you get the average. So what we do then is it's a bell curve. It's literally this simple. And the average is that right down the middle. That's the average. We'll just say 8% is the average, 8%. All right. But the issue is none of these guys work for free. And they're all charging a fee. So if the average gross rate of return is 8 and the average fee is 1, that means the real return that you get is it's almost like an economic graph, but it's a bell curve, is actually 7 because the fees. So if I can capture the average gross without getting the fees, I'm going to beat a significant portion of most investment managers, because most investment managers are right around average, maybe a little bit higher gross of fees, but net of fees, they're lower than average, most. And so because that, if I can get if I can get the average rate of return, I will beat most managers because most managers charge a fee. And as such, with the fees included, most managers underperform the average. There are some that outperform. The question is, you can't identify which ones will outperform in the future. You just can't. Because the ones that outperformed previously, did they do it by luck? Did they do it by skill? Well, maybe the skill that they brought to the table is no longer. We don't know. But you can never pick the outperforming manager. You just don't know who it's going to be. It's an impossibility, my friends. It really is. So you just buy the index, keep your fees low, and be done with it. All right. So let's go to this article from an advisor perspective. So this guy, and I'll have a picture, not very professional, but be that as it may, who am I to talk about professionalism? He talks about how investment expenses erode safe withdrawal rates. He gets into the whole thing about the bell banging 4% rule and John Bogle and all that. And we're going to John Bogle, investing, you get what you don't pay for, 100% right. So we're going to skip all this and just kind of go down to the right here. We're going to talk about the for comparison purposes, let's see. Retirement simulations will run over 20, 30, and 40 years at annual expense burdens ranging from 0.1 to 3%. Since January 1926, there have been 898, 778, and 658 rolling 20, 30, and 40-year periods, respectively. Now, remember, I'm not a big fan of using these rolling periods because they're so, they're not statistically relevant. They're just not. The reason is because if you're using 30-year rolling periods from 1926 to 1955, 30-year rolling periods from 1927 to 1956, there's 96% correlation in those 30-year rolling periods. So that's not statistically relevant because they're so tied together. But be that as it may, we'll run it. For comparison, we use two portfolios. The first was named the 60-40 portfolio, which contained a traditional 60% large cap stocks and 40% intermediate bonds, government bonds. The second name was after William Bernstein, the intelligent asset allocator, which he has equal weightings of large cap, small cap, international, intermediate government bonds. All right. Portfolios were rebalanced annually. Lastly, the concept of safe is defined here as the maximum level of spending that could be maintained historically while attaining a given goal of 90% of historical periods of a specified duration. So a 90% Monte Carlo, essentially. We're not using Monte Carlo, but saying 90% of probability that we don't run out of money. All right. Of course, and we are adjusting for inflation either. Withdrawals were constant in real terms, adjusted for inflation. It's strikingly how strongly investment expenses eroded safe withdrawal rates. Over 20-year horizons, the safe withdrawal rate for the 60-40 portfolio was 5.3% at an expense ratio of 0.1. In order, 5.3% was the highest rate of spending that could be sustained in 90% of the historical 898 times. In 10% of periods, this rate was too high and the portfolio ran dry before the 20 years were up. At an expense ratio of 3%, though, the safe withdrawal rate fell to 4.1. That is, in order to remain solvent at the same historical frequency, this higher expense burden necessitated a whopping 23% decrease in spending. For a portfolio with an initial value of $1 million, that's a drop of $1,000 a month in spending. That's crazy. The pattern played out similarly over 30 and 40-year retirement horizons. Safe withdrawal rates tumbled from 4.3% with a low expense ratio to 3% with a high expense ratio. Over 40 years, it went from 3.9 to 2.5, more than a third reduction. He's got the table to summarize it. So let's just go to 0.1, which is index funds. We'll use a 30-year rolling period. You got a 4.3% safe withdrawal rate. But if you have a 1.5%, you have a 3.7% safe withdrawal rate, which is a difference of $600 a month, man. I mean, that's $600 a month. That's enough for Medicare premiums for you and your beautiful, for each of you guys. I mean, that you're paying. You are paying your investment advisors Medicare premiums, if that makes sense. It's also striking how much better the Bernstein portfolio held up. And again, this is more diversified, and that's fine. Over each of the three horizons, the Bernstein portfolio supported appreciably higher withdrawal rates than the 60-40 portfolio. The Bernstein portfolio supported a withdrawal rate of 5.3% versus 4.3% for the 60-40 portfolio over 30 years. So basically what this kind of goes back to a lot of guys are saying now, when you have a diversification with some small caps, international, whatnot, and you're spreading out more than just large cap and bonds, it gives you a higher safe withdrawal rate. I agree with that. I don't have any qualm with that. I don't take issue with that. I think that makes sense. You're spreading your risk among many different asset classes, and thus you could be getting more of a boost on some of those asset classes. All right. Not an expense burden of, let's see. All right, so not only did the Bernstein portfolio support higher safe spending levels, sustainable spending suffered proportionally less from higher expenses than it did with the 60-40 portfolio. While an increase in expenses from 0.1% to 3% forced a 30-year spending down by 31%, the decline in safe spending was only 29% with the Bernstein. You're still talking a third of your capital just by paying some guy more. It's crazy. And he shows the summarization here. So again, if you have the Bernstein where you're splitting it among small caps, large caps, international, and bonds, the 5.3% is your safe withdrawal rate for 30 years, where just a typical Bill Bang is 4.3, $3,600 a month. With a Bernstein is $4,400 a month. You're actually generating $800 a month more investments. Difference in the safe 30-year between Bernstein and 60-40. You can see it's a significant more in terms of money. The more diversified, the more money you made. That's where they say diversification is, quote, the free lunch, unquote. Well, it is until it's not. That's the thing. I hate to say it, but if you had small caps, you were not diversified, but you did significantly better small cap value, most likely. I haven't run the numbers, but diversification is not a free lunch. It's just not. I'm not. I think you should still do it, financial planning 101, but it's not a free lunch. That if you diversify, you're going to get better returns. It has in the past for sure, but not in the past relative to some other things. Diversification depends on what you're comparing it to. And here's a historical 30-year safe withdrawal rates under various expense burdens. So if you got a 1.5% expense burden and you're using a 60-40 portfolio, you're sitting at about 3.75. Keen readers will discern that even at twice the annual cost burden, the Bernstein portfolio supported higher spending than the 60-40 did. All right, so that's the Bernstein port. Okay, so there's a big picture. That's all I wanted to talk about. It's worth recalling that we're dealing in historical data. The future cannot be predicted, but the past offers important clues. Asset allocation is a tricky matter. Some advisors may look at the Bernstein portfolio and feel hesitant about such a high proportion of small and international stocks, yet the numbers don't lie. Superior results to those of the 60-40 portfolio could be achieved with an infinite number of alternatives, right? Whatever strategy is chosen in consideration of cost is vital. I could not agree more. So let's see what the comments were here today on this article. I mean, it inherently makes sense. Bill Bengen, I've also been asked why I didn't include investment expenses in my SWR analysis. My response has always been it varies so much from an investor to investor. It would be difficult to quantify without misleading a significant number of retirees. So that's cool that Bengen respond. Right on, Bill. Here are the results from the Bernstein portfolio. All right, so this guy says clear retirement investor would have fared substantially better over the last 50 years by investing in a more broadly diversified global multi-asset portfolio. Unconventional asset strategies. Okay, but see, that's the thing. In hindsight, all these it just drives me crazy. All these back testing. If you would have done this, you would have got okay. Is that going to happen in the future? No one has any idea, but pretty good. I like it. So I'll put a link in the show notes and I'd like to hear your thoughts. See ya.